Hey, welcome to the Hive with Us podcast. I'm your host, Daniel Martinez. Today we have returning guest, Mr. Kevin Almosch from Pine Financial Group. If you have not heard his other episodes, please go check it out. It's episode 371 and 374. Kevin, how are you doing today?
Daniel, I'm so happy to be back, man. Excited for it.
Yeah, it was kind of unexpected. I like having return guests, but man, you're one of the people I definitely wanted back to have another conversation. I don't even remember what we talked about last time, but we're going to have a different conversation because I have some deferring questions for you.
Okay, good.
Because one thing I love about Kevin here today is Kevin is on the financial side of real estate, which is what I love. And it's always fun being on the finance side. But you've been in real estate 15 years, if I remember correctly. This is from my memory.
Yeah, so 2 decades in real estate, and then I started Pine 15 years ago. So Pine's 15 years old. I was doing lending 2 years before that. So 2 decades real estate, 17 years on the lending side.
So last time we spoke, which is actually over the weekend because I was on your podcast.
That's right. That's fun.
Can you plug your podcast in real quick?
Yeah, the Real Estate Educators Podcast.
So I was just on his podcast, and we're talking about how Kevin loves what he does. So we're going to dive a little bit into why he loves the financial side of real estate and why it's the best part of real estate. Because I think me and Kevin are on the same page in this one. So first of all, please go check out the other episodes because we're not going to repeat the same things here. But why is the financial side of real estate the best side of real estate in your opinion?
Well, it's like what we talked about on my podcast when you came on. It's the deal structure, man. It's so you could be so ridiculously creative in real estate when you can negotiate, the financing. So the deal structure, how you negotiate it, how you make your offer, how you present that offer, as you were telling me with that amazing deal you just did, has everything to do with how you're going to finance it. And when you can start bringing in owner financing or private capital and keep the banks and institutions out of your business and your deal, man, it just opens up an entire world for you.
Are you still active on the actual deal side, or are you more on the lending side 100%?
So no, I'm definitely still active investing. I'm trying to do much larger projects now. So I've got a portfolio of single family homes, and I love them, hate them. They're great, but I'm looking for the bigger profits at this point in my career. So we're looking at more larger commercial, doing some developments like you do. So that kind of thing.
Okay. So you're active and so let's talk about that. So how do you have a team? How big is your team for the active, and how big is your team for the lending side?
Yeah, so the active is really just me.
Okay.
You don't need a ton. I mean, I can lean on my office when I have tenants that call in or they want to bring in their rent, and I have someone help me with the book. So it's pretty much all outsourced at this point. The lending side, man, we're just rolling here. We'll do 20, 25 deals a month. So I definitely need a team for that. There's 13 of us on that side.
13 active on the lending side.
On the lending side, right?
I mean, that's not bad. That's not a bad. Are they all virtual or are they in office?
Yeah. So if you add the virtual, we have 2 virtual assistants. Otherwise, we have 1 person in Minnesota because we do a ton of business out there. So we want boots on the ground there. And then we have 1 person in Texas, Kim. She's amazing. She was my very first employee. So I hired her in January of 2009. Wow. And she's still with me today. So we're like, sure, you want to go to Texas and work remote? We're going to definitely give you that flexibility. So she's there. Everybody else is in our office here near Denver.
Awesome. That's okay. So that's why have a person on the market specifically? Why is that important?
Yeah. And maybe it's a little bit different on the lending side than the active side, although I do think that you need some local talent on the ground on the active side as well. But for us, we do a lot of construction lending and rehab and lending. So we need to go out and inspect the property and make sure that it's getting done correctly. Now, I know you could outsource that to title companies, and there's national inspection firms and all of that, but I want someone that I know and I trust to be giving me honest, accurate reporting. So that's why we decided to have a person on the ground in Minnesota. And we do quite a bit of loans out there, so it just makes sense.
So every property you're doing a loan on, that person is going physically to the property and inspecting it?
Yeah, on the residential side. The commercial side is different. More sophisticated, high net worth borrowers. So we're not as concerned. Their personal guarantee carries a lot more weight than someone that's kind of just getting started. But yes, we want to look at every property.
show is sponsored by HiveMind CRM. It is more than just a CRM. It is a real estate and business mastermind that comes with an all-in-one CRM. You can have unlimited websites and users. You can call, text, RVM, and email all in one user interface. And you can set up custom automations for any type and multiple businesses. 65% of companies start using a CRM system within the first 5 years of business. Once implemented, the HiveMind will save you on marketing, give you more time, and make more money. One of our users had his first $100,000 month using our system in June. We want to see you automate and accelerate your business. Text us at 210-972-1842 for future meetings, and of course to get our $1 course on how to make more than 6 figures on one land deal. You can schedule your free demo today at hivemindcrm.io.
So one thing, I have a question about that too. So I asked the commercial lender about this, but I'll ask you, but does your basis on you lending on the deal, as far as what's the difference between single family and commercial property as far as that lender? Is it more to the deal or more to the lender, or more to the lender, more to the deal? Because I'm sure it varies for both.
Yeah, so on the residential side, we're very deal heavy. So we're like asset-based lending, right? So we don't care so much about credit as much, more now with the current environment, but we don't care as much about credit. We certainly don't care about a debt to income ratio. Like, you're not going to be servicing this loan with your income. This is typically short-term fix and flip or repositioning loans. So the asset itself is going to be what's paying us back, not you. So we don't care about income. But we want a good quality deal, right? If you're not getting into a deal that's going to be profitable for you, one or two things is going to happen. One, you're going to default on the loan, or two, you're going to not default but lose money and then never do business with me again. So we want to be very careful with that. On the commercial side, we got some strong guarantees, so we're less concerned. I mean, I'm still concerned with the asset, but I'm more concerned with the personal guarantee and how strong that is. And then on the asset side, we lower our loan to value. And here's why we do that, Daniel. Commercial assets fluctuate. They're more volatile than a residential asset. And with what's coming, I believe what's coming is some market softening on the commercial side. We want to be just a little bit more conservative. So we're capping our loans at 65% of a stable value. And on the residential side, we're 70% of the as completed or after repair value.
Gotcha. So essentially, if they're commercial, they have to put up more capital because it is more volatile. So it gives you, insures your risk that you're putting in.
Yeah, exactly. I mean, gosh, cap rates have been compressed for so long, and with interest rates high and remaining there, you have to see cap rates go up. And for the listeners that don't understand, it's an inverted relationship. So if cap rates go up, values of the asset come down. You have to pay less to get a higher return, right? So I believe we're going to see cap rates increase to keep up with this expensive lending environment.
Yeah, 100%. It's just crazy to me because like it's barely like softening. Like people are still selling, like you still see like the 4 and 5 caps still out there. I'm like, interest rates at 8%. What are you guys doing?
Yeah, what do you think about that? Is that sustainable?
I mean, it's not definitely not sustainable. It's just it doesn't make sense to me. And I get both sides of it because some people are like they're trying to sell now to exit to possibly still get that cap rate, but it doesn't make sense to me.
Well, what if you're entering at a 4 or 5, like you say, and by the time you're ready, it's repositioned and you're ready to exit, you're exiting at a 7, which is probably where you should be. 7 or 8 is what you should be at probably. And now you went from a 5 to a 7. That kills your value.
Yeah, it definitely hurts it in the long run. Any type of NOI or value increase is probably out the window at that point.
Totally. Yeah, zero value increase. Even if you increase the income, which is the whole idea, you're still lost value. At that point, you just keep it probably.
Yeah, just cash flow it. Are you doing like bridge loans or are you doing like long-term financing for this commercial stuff?
Yep, it's all bridge, all short-term. The difference is to reposition a commercial asset is a lot longer than to fix and flip a house. Right, so you could be in and out of a house in 4 or 5 months. That's pretty common. On the commercial side, to reposition it might take 2 years, and then you have to season the new leases before the bank will look at it. So you might be 2 to 3 years to reposition something. So it's just a slower process.
I didn't realize you had to season the leases. That's new.
Yeah, not always. Not always. Every lender, see, in the commercial space, it's not like, I mean, you have some institutional government, institutional money like Fannie, Freddie in the multifamily world. But if you start talking about warehouses and retail, which we do a lot of, there's no big institution other than the banks that do that stuff. So every bank has their own different guidelines because they're keeping those loans on their portfolio.
Hmm.
Does that make sense, or I go too fast?
Are you doing an adjustable rate for your commercial loans, or is it?
It's interesting you asked that. So I get that question a lot. It's crazy. Very few private bridge lenders do adjustable rates. They're just not set up to do that.
Okay.
So we have a high interest rate, but it's not adjusting. And what's interesting about this is a lot of my peers and competition, their rates have gone up because they're getting so much of their money from lines of credit.
Yep.
Or from the capital markets. Most of our capital is privately raised, so we have a pretty fixed cost of capital. So we've maintained our pricing through all of this crazy environment while all of our competitors are increasing. And we've chosen to do that, Daniel, because, well, think of it this way, supply and demand, right? So there's an increased demand for bridge loans right now because capital constraints, banks are tightening. So demand is up, but our supply is still, maintaining similar levels. So that typically would drive up value, right? Price, high demand, low supply. We've chosen to slow demand down by tightening guidelines a little bit, just being a little more conservative. We want a higher quality portfolio. So we've just tightened up a little bit instead of increasing prices. So everyone around us, prices are going up, we're maintaining.
That's really cool because I think a lot of people there's a lot of different lenders out there, but I think that you having private capital, which makes sure your price is stabilized, is priceless. Because, like I said, if you have some type of institutional backing or some type of line of credit, like you have to adjust. I mean, there's no ifs or ands about it. It is what it is. You have to adjust because you have to make sure you're covered.
Yeah, think about this. One of our largest competitors in Colorado, almost all of their capital is from lines of credit from different banks.
Mm-hmm.
And in 2008, when I was just getting started in this industry or with this business, the world was crumbling in around us, at least the credit markets was, and their line of credit got shut off. So they had no more access to capital. Now they had all of these commitments in the pipeline, right, with no ability to fund. So people started not getting their construction draws. People had deals that were getting ready to get to the closing table and there's no money for them. All of that just fell apart. So I think anyone that's highly reliant on lines of credit could have some risk here.
That's man. You as potential lendee doesn't even think about that, but I hope that pricked your ears, everybody listening, because that's scary.
Yeah, and who knows what's going to happen? I don't think we're going to go through 2008 again, but that was significant, right? But banks did shut lines of credit down. That was happening across the board. How many lenders went out of business because they weren't structured properly?
Is this from experience, or you just built it that way from the beginning?
Well, I mean, I started doing this in 2006, but I wasn't able to go out and get lines of credit when you can't get lines of credit when you're just starting because you might have a portfolio of, let's say, $1 million, right? These lines of credit are 20, 30, 40 million. That's kind of the starting point.
Yeah.
And you need enough collateral to feed into that line to be able to access it. So here's how it works, Daniel. Let's say I have a $100,000 loan, to keep it very simple. We might have an advance rate on a line of 65%, maybe 70 if you're super lucky. So of that $100,000 that I put into a loan, I can now use that loan as collateral to draw maybe 65,000. Okay. So your client usually has skin in the deal, and then you as the lender has skin in the deal. So the bank is being very, very safe, but it doesn't give you to get access to a $20 million line, you need, I don't know, $26, $27 million of collateral to get that, right? So it doesn't make sense when you're starting out.
Ooh. One thing I think is crazy because like I think you're alluding to it, but like you starting out not being able to get those credit lines almost made you safer than everybody else because you didn't have that availability. So now you just operate in that, you have that safety factor already built in, and like, where everybody else is they might have had that ability to extend. Now they're operating loosely. That's a loose term, but loosely.
Yeah.
They're operating loosely, and there could be ramifications to that. And in this market.
Well, yes, and exactly what you do. Like you're very creative, and you can go out and meet with an owner of a land deal. Are you still there? Oh, I thought I lost you there.
Yeah.
You can go out and meet with the owner of a land deal and figure out some terms, and you could potentially buy these properties with little or no money down, or lock it up for a long period of time so you can go and bring in your capital from selling a piece of the property off, or all the different creative, cool things you do. Now, you've learned that because probably you were forced to.
Yep.
You didn't have unlimited resources, as much money as you could possibly have. So I had a buddy that started investing about the same time I did.
Okay.
So we were 21, 22, and he had family money, so he had a huge advantage on me. I was freaking broke, man. I didn't have money growing up. I had to earn everything. I had to pay for my own school. I had to pay for my own cars. I had to pay for my own gas insurance. I didn't get any help. So I started investing in real estate. I had to learn how to do that without any cash, right? So I created this creativity that once our career started going, he saw me accelerate much, much faster than he would because he wasn't able to structure deals the way I could. Ooh. And then I remember him sitting down, we were having some drinks, and he sat me down. He's like, man, I wish I didn't have that ability to just go out and get capital. I wish I was forced to learn creative finance.
Boom. One thing I love about this is I think a lot of people, they want the easy route, but the easy route might not be the best route. And not knocking your friend at all, but I think when you're forced to go through the trenches, you get a lot of experience going through the trenches, and it's priceless. You really can't put a price on the education of going through the trenches.
Yeah, that's exactly what you're doing right now, man. And I know you have your fund coming up, and you're going to be doing some really special things. And investors that are looking at something like that should have a lot of comfort because you've been in the trenches, right? You know what the hell you're doing.
Yeah, that's so cool, man. I really appreciate that because it's been hard, man. It was hard for. I'm sure it was hard for you for probably 5 years, maybe 7 years.
Oh yeah. Then I lost. I mean, I lost everything, right? Because I went up to 2008, and I was so young and naive, and nobody saw it coming. I mean, people say they did, but no one really saw it coming. Yeah. I certainly didn't. I wasn't smart enough to see that, and so I was not structured appropriately. And man, it took me down, and then I had to rebuild again. So, millionaire long before I was 30 years old, lost it all, and had to rebuild again.
That experience is priceless.
Just definitely helps. Yeah.
Now
I'm super conservative. You hear probably in my tone, like something's coming. Like I don't know what it is. I'm just being very careful now because I've been through it.
Yeah, that's amazing, man. I really appreciate like the struggle side of it because, man, everybody looks at like probably you now and like, oh, you probably got a leg up, and like no, he struggled for a long time.
Yep.
There was a long time struggle behind that, and you got to look a little deeper sometimes.
Yeah. Not a lot of investors have been investing since before 2008, so they don't really know what's coming.
Yeah,
they don't quite understand. It's been rainbows and roses and all of this unicorns for the last 15 years. We haven't seen a correction.
Yeah, and that's one thing. I'm like, I was 2008. I was 16. You know, and I the reason why I do stuff like this as a whole is because I want to listen to more experienced people and pay attention to what's happening, understand how every part of it works, because if you understand how the financing works in your business, then it makes me operate my business accordingly, because it all feeds into each other. Everything's connected but not connected, and there's so many sub niches that affect each other through the line. You have to know a little bit about everything so you know how it flows.
Yeah, that's a good way to describe that. And especially in stuff that you're working on, they call it the capital stack. So how are you going to bring the money in to take down the project? Like in residential, you don't really have a capital stack. It's usually a down payment and a loan, and it's pretty simple, right? when you start getting more complexity, then you are going to start laying in different types of capital. So to understand private bridge money, it is important.
Yeah. Yeah. And like I said, it's something that you might not understand, but you want to. You definitely want to understand because, and this is why I always ask like what the lending requirements on the back end of each lender that I talk to, because that should open your eyes, because every lender I've had on, I always ask them that question by itself, because I want people to understand like what are they looking at as a whole when you have a deal, because I think the biggest thing is finding great deals is always number one, but if you get the financing is always number two, because you need to find the capital to close it or raise the money to capital to close it, and what terms are you offering. And this is where like, hey, I heard Kevin on the podcast. He's buying this one's loan to value. I might need to get better deals,
Right. Yeah, no, I love it. And I tend to agree with you. And I would just challenge that the money's pretty darn important. So in some cases, you might want to at least line up a loan or a lender prior to finding a great deal, at least so you have some direction once you get it under contract. I hear all the time, the money will find you if you find a good deal. It's just not always the case. So I would maybe in tandem look for money and deals, but don't forget about the money.
Man, I think right now every deal we have, we send to like every lender we have till we lock them in, and then we move on to we send every lender we have every deal, because I don't know what they're going to take, and we need to lock everybody. We need to lock certain lenders in on certain projects, and depending on because even with us in land, like I'll have people like, I don't want to do anything over 300,000, so anything under 300,000 we send to those guys, and then like I want to do 500,000, but I want to do at least a couple deals with you in the lower range. Now we're like, okay, we need to find more deals in the lower range just to build up that credibility with them over time. So now we're on the hunt for smaller deals just to build, because they have that comfortability of like $500,000 or more, but they want to do a couple of deals with us on the smaller range. Okay, so now we define smaller deals. So it's kind of like picking and choosing and kind of working that capital. I'm working the capital with the deals. So I'm actually finding the capital than the deals.
Yeah, I honestly believe that's a great way to do it. And you're right. Lenders have different appetites, and their appetites change.
They do.
Like for us, for example, I mentioned that we're tightening guidelines a little bit. Well, we've reduced our maximum loan we were doing deals over 6 million, which is small, but for us, that's big. And we lowered it. So now we're not doing anything over 4 million, because we just want to create more diversity over our portfolio. But that just changed. Like overnight we met, we're like, let's stop doing it. If you and I talked a week ago and then we changed that, and then, you might be looking for a $6 million deal and now we can't do it anymore. So it's a constant work in building those relationships.
And I think having constant communication with your lenders as a whole too, because that decision can be made overnight.
Yeah.
And you need
especially in the private capital side. It's like institutions, they change too. Their appetites are constantly changing too, but private money, for sure.
Yeah, we just talked to a private money guy, and I was telling him, I was like, maybe it's not the time. Maybe it's not the time. We need to build up a balance sheet a little bit more, and we'll talk to you in a few months. And it is what it is. But I don't ever like push people away just because they didn't fit our lending criteria right now. I was like, let me put you on the Rolodex, and we'll add you. And if I get something that fits in your parameters, I know who to call next time. And we'll see if we get some opportunity working. Because, I mean, it's really, really important to network with other lenders in your markets. So let's talk about that. What you said you're lending in Colorado, Texas, and Minnesota. Are you lending on single family and commercial in all three, or in certain markets?
Yeah, so my PAM moved to Texas. We're not quite lending there yet, but that is on the radar. Okay. So on the we're 80% residential, 20% commercial. So we're heavy residential, because I feel it's more liquid, it's easier to cash flow, and safer. So I like that. On the residential side, we're Colorado, Minnesota. Those are our two primaries. We also do quite a bit in Wisconsin, and now we're doing deals in DC. So we might do 1 or 2 deals a month in Washington, DC. So there's a story behind each move. I know it's kind of scattered, but so those are the 4 markets we're on the residential side. On the commercial side, we will look across the country. We're funding another one in Chicago this week, for example. So we're kind of spread out, but again, we're chasing those balance sheets. So we're looking for higher quality guarantee and a good, strong project.
Yeah, 100%. This is a side question more on the organization side. What does it take to become a lender in the United States, as far as like through your, are you guys regulated? Do you have licenses? You have to follow a certain lender. I know you have to follow certain lender requirements, but like what does that look like on your side? Because I'm really curious about this one.
Yeah. So private money is very crazy. And the reason I say that is there's no federal regulation around it. So it's all state level. Some states require licensing and they have like reporting requirements and that kind of thing. And some don't. So for example, in Colorado, as long as I'm sticking to business purpose loans, I'm not doing any owner occupied. So only residential if you're going to flip it or rent it out, and commercial. As long as I stay in that world, there's no licensing requirement or regulation at all in Colorado. In Minnesota, you do have to be licensed to do private money if the collateral is residential property. So it doesn't matter what the purpose of the loan is, it matters what the collateral is. The difference is you don't have to have individual licensed mortgage officers, loan officers. It's only a company license. So see, it's like each state's going to be pretty unique. Yeah, Minnesota, we have reporting. We have to report once a quarter to the National Mortgage Licensing System, the NMLS. Now, that's on the lending side. Now, if you're going to start bringing in capital and start putting together funds or selling off notes or brokering private notes, there's a lot more regulation around that, because now we're talking about securities laws. So in Colorado, to broker private notes, we have to have a securities license. It's called a mortgage broker dealer license. And so it's just a broker dealer, but it's dealing with mortgages. And you got to pass a securities exam. It's a Series 63. Then you have to be bonded and you have to have all of that. So we have all of that in Colorado for the transacting loans that are originated, but you don't need the license to originate. And then Minnesota, opposite. You don't need a securities license, but you need the lend money. You need the lender license.
Gotcha. Okay. So it's a little different for everything, and this is where like I think a lot of people, they want to get in the financial side, but it seems intimidating.
Sure. Yeah, because it's so capital intensive.
Yeah. So let me ask you this. So to get bank capital, you have to have a balance sheet. To get private capital, it's just relationships, right?
Yeah. Yeah, it's just like what you're doing, raising money in a fund. It's just that. So if I could meet an investor that's interested in investing in a fund, and I can convince them that my fund is their right investment, then they're going to invest with me, right? And then I could go out and use that money to generate business. So it's just selling. You got to have a good product, and you got to be credible.
Yeah. Which takes time.
It takes time. Yeah.
It takes time and experience. But I really like the financial side of it, because it's just like, it's more the values in the paper and the asset. You don't have to do all the work.
Yeah, you said that in our episode, right? You could create more value with paper than you can doing construction or remodeling, improving a property or something. Yeah.
It's such a cool dynamic. What's the future look like for you? Because I know you said you're doing larger deals now. You're focusing more on that. Are you kind of hesitating in that? I know you say you're kind of outlining your guidelines. Like, what's the future look like for you in the next like 2 to 5 years? Because are you adapting to the market? Are you still going to bigger stuff, or what's that look like for you?
Yeah, so on the Pine Financial side, I'll just be real transparent with you here. We generate revenue of around $7 million. Okay, and we want to go to 20. So I think once we hit that, then I'll be in a better position to take a step back. Yep. I'm sort of taking a step back now, but I've got an executive team, which is huge. Once you can get a good, solid leadership team, 100%. Then it allows you to get more flexibility. But I think I could take a big step back at that point, and I could focus more heavily on my own personal investments. So that's the Pine side. My personal investment sides, I want to do more commercial. I don't like land development or land deals as you do. I'm more like, I want to reposition assets that are already there. So I'm looking for retail and industrial, and the reason I'm focused on those two is because that's what a lot of my clients have done. So I've just the reps, right? I've seen those deals over and over and over, and I can see how it works.
Yep.
So I've gotten on the auction sides, and I've bid on these, and I haven't won anything yet. I'm working with brokers, bring me deals. Nothing is penciled yet, but I think that's going to change as the market softens. So it's got a little bit of dry powder, and I'm ready to pull the trigger when I see something I like.
Yeah, I think it's he's got to be active in the game, and I think 100%. I don't know. I don't push anybody because I think your experience is in those already creative deals because you've done that for years. So why learn something new if you already have that experience and repetition and you already know that asset class? It's huge. It's huge notch in your belt that not a lot of people have. Are you playing an exit out of Pine Financial? Is that like a future?
It's so hard. That's a tough question to answer because ideally I'd like to pass it on. So
Okay,
I'm
that's
engaged and we've been together for 7 years. She's got 3 kids. I have 2. So we have a blended family of 7.
oh amazing.
And so we have a lot of kids that may want to take over the business at some point. And I talked to them about it, but they keep telling me, no, I'm not doing it. So I don't know if this is going to be a generational thing. We might exit at some point. But if that's the case, my plan is to get it out so it's passive. Somebody else is running it, and it's just producing, income.
Royalties. Yeah.
Yeah, exactly. It's very similar. Yep. But if the executive team who participates in the upside chooses to sell, then I would be on board with that. So I think I'm going to kind of leave it more up to them. My goal is just get to a point where I don't have to work.
Yeah, 100%. I think it's a great goal, and I really appreciate the passing down the thing. But a lot of kids don't understand, and they might regret that in the future. But you can't force it down their throat.
And there's a couple of entrepreneurs in the group, man. So who knows? We'll see what happens.
What's the range of the 7 kids?
Yeah, they're all really tight together. So it's between 13 and 17, and they're all 5 in that range.
Woo!
That's crazy, huh? They're all in the same classes at school, and it's pretty fun.
That's pretty cool, man. Well, they're all right there. Anyone can make the decision to at any moment. So, I mean, you'll probably know. I know. I don't think you're retiring anytime soon, but I think you'll know in the next 5 to 10 years.
Right. And real estate has been such a blessing to me. I can't even tell you how grateful I am for this.
Yeah.
But I've been in a position where my passive income is more than my expenses. I've been in that position for years and years. I just love this so much. I would just like to be able to take a step back from Pine because I want to focus more on my own. But I enjoy, like you, I enjoy the deal structure. I love putting it together. I like that more probably than the Pine stuff. But man, I'm having fun with this too.
It keeps you busy, and it's like you love what you do. It's not necessarily work for you,
Right, and I get to help people. Right, I help my investors make money in the fund. I get letters all the time about how that's changed their life to be able to consistently count on this consistency. And then I'm helping my borrowers, people that are borrowing the money, create financial freedom as well because they're out there fixing and flipping or doing commercial deals, and they're all making money. So it's just a good business to be in.
Is your back end on the fund model? As far as the capital stack?
What do you mean?
Is your private capital on the fund model itself, or is it like private?
So we have multiple sources. So we actually have 4 mortgage funds. 3 of them are Reg Ds, which are private offerings. Like you're not really allowed to advertise. You have to know that kind of thing. Now some of that's changed with the new laws with the Jobs Act and all that, but those 3 weren't like that. It was definitely build relationships and then make the offering. And our most recent one's a public fund. It's a Reg A, so I could actually advertise that one. So we have 4 mortgage funds, and we are layering in a little bit of debt with lines of credit, but it's about 10% of the total portfolio, actually a little bit less than that. So we're still in a really strong position. And then we sell off individual loans when we need additional liquidity. So let's say we have a deal coming up that we need to fund.
Yep.
We might sell some loans. That's where I need the license for, right? So I might sell some loans to generate some extra capital so I can close on that loan. So it's kind of where we got it from many different sources, and there's revenue streams from each one depending on where the money's coming from.
Were you always on the fund model on the 4, or is it kind of recent adaptation?
We started the first fund in 2009, but in 2006 to 2008, when I was working with somebody else, all we did was private note, like brokering, right? So I would bring in, let's say John had $100,000 and Sam wanted $100,000. I would just bring those 2 together and charge a fee for it. And then once I started in 2008, I continued that model until I was getting feedback that, hey, it's getting too expensive. We need options where I'm not putting all my money into one deal. So I need more diversification, a lower investment amount, and I want some liquidity. look, debt isn't liquid. Despite what you hear, you can sell notes, but there's not a market for it. So if you don't know somebody who wants it, then you're going to probably have to discount the note to get it sold. So we don't call notes liquid, right? But they wanted liquidity. So if you created a fund and you're invested in a lot of projects that are paying off and money's coming and going, there's some velocity there, that created the liquidity, a much lower investment amount, and then obviously the diversification. So we started that fairly early in the career, about 1 year into Pine starting.
Oh, okay. Okay, that's good. Yeah.
And then it's just been a different fund. Each time we hit a threshold from the Securities and Exchange Commission, we start a new fund.
Yeah. Well, one thing I've noticed now that I've been delving into the fund space is that a lot of companies are, and I didn't know that till I asked that question. So like a lot of people, they use the fund side of it, but don't actually, I mean, sometimes they can't say, and B, like it gives them a lot of like amplification of capital that is really required in some of these businesses. And that's what I'm learning, is that a lot more people use it than you think, and the people that use it are really sometimes doing bigger things than normal because they have that in their back pocket.
Well, that all came out of the Jobs Act, right? They started the Reg A Plus came out of that law, so they're allowing small companies like you and me to publicly advertise our security now. That was never a thing, right? So they're trying to. And I say I'm just talking about lawmakers in general. They're trying to make it help companies to create more jobs, right? That was the whole point. So if we could help them raise the capital they need, then it's going to create jobs, and that's good for the country. So that's where it all came from.
Yeah, I think I've learned a lot over like the last 6 to 12 months, because I realized that there's a lot of good businesses out there. They're just not funded properly. So once you get the right funding, you can really amplify and create a lot of business opportunity, wealth creation, job creation, asset creation. I mean, even development or remodeling, like there's a whole thing that comes in that once you get the capital in place, and it's just creating the right vehicle for people to invest in. That's all it is.
Yeah, and this is something good for you to know with your fund coming up. It's probably going to be a lot of accredited investors, I would assume. So you're going to want accredited investors. Yep. So there's some discussions right now, Daniel, that they were going to add an educational requirement to become accredited. So you don't necessarily need to hit the financial requirements that we have set today. There may be an option for somebody that wanted to invest with you to go through a little class and maybe take a small exam all online, and then they would qualify as accredited, and then you could accept them as an investor. So we'll see where that goes, but that's going to open up a lot of potential investors to us.
That's amazing. So I think the accredited investor requirements, people hit them, but it's very hard to hit them. As especially this is where I think like the threshold to become wealthy, you have to have money, and it always hinders the people that are starting from scratch. So I think opening up that threshold, I think it creates a lot more opportunity, because a lot of people don't even understand. They might not even heard accredited investor term.
Yeah. Well, it's kind of a weird requirement, because they use the accredited investor so the government knows they don't need to be as careful with them. They don't have to protect them as much as the non-accredited. But what's interesting is, because it's a net worth requirement, the main one is a net worth requirement, people might have an inheritance, right? And get this money, then all of a sudden become accredited and not know what they're doing. Yep. Right? And they're going to be investing in projects, and they don't know how to analyze risk. Right, so it's weird that it's only a financial requirement when that doesn't really tell you much about their sophistication, right?
100%. There's 100% wealth backed down, and then it just fucking disappears into the ether from bad GPs and bad funds and carelessness. That's
right. Yeah, so maybe an education piece makes a ton of sense. That's a better way to keep people safe. I believe.
That's huge. I think that's huge, man. Education, I think, should be paramount with everything. And I think if you are a accredited investor and don't know what you're doing, please get educated, because that opens up like I always advise people, like people that inherit money, like I always tell them, like, dude, you could do this. You can do. There's a lot of things you could do, but if you don't know what to do with it and how to make money with money, you're gonna burn it, and you're gonna burn it real quick. I mean, I see it all the time with people inheriting capital, and you hear the horror stories of the lottery people, and it's just it's a bad. It's a hindrance more than a help to some people.
Well, it's an amazing statistic, which I don't know what it is right now, but the number of inheritance that are supposedly generational that last one generation.
Yeah, they're gone.
Like like 90% or something. It's like staggering how much, if you don't teach your kids and educate them, when they get the inheritance, it just goes away.
Here's a parent question. How are you instilling that in your kids?
It's tough, man, because we live in a neighborhood, like a nicer neighborhood, and there's like all the kids are getting their cars paid for, and they're all turning 16 right now because that's where the age that we're at.
Yeah.
All the parents are buying them cars and paying their debt and they're doing all this, and we're just not doing that. So now our kids they feel like they're at a huge disadvantage because we have one car that they can all share until you go out and save up and buy your own. And so they're learning an extremely difficult lesson right now, right? They have to go out and work. We play cash flow. I don't know if you know the game.
I have it.
Yeah, I love that game. And it gives you such a great opportunity to go through different lessons with the kids. So we'll sit down and play it, and then we'll start getting more creative. Like, oh, you want to buy this property? There's no rules here, right, in this game. So you're just like, well, why don't you two partner up with me, and then we'll buy this property, and then we'll split the profit. And we start talking like real life examples on how we can do this. Yeah, but that game allows for that, right? So we play that game, and then, man, I've been trying to. They're all working. We're trying to get them to start being interested in Pine, right? So two of the middle little kids, Branson and Maddie, they're going to start running our our TikTok. I'm not on TikTok yet, so it's the TikTok one. They've been telling me for years, I got to get on TikTok. I got to start doing this. So I made them put together a presentation. They did it all in PowerPoint. They came in, they presented to our leadership team. They went through the whole slide deck and gave the presentation, and then they just got the job offer. So now we're getting ready to start this new social media thing. And I'm trying to think of different ways to, make sure that they're not spoiled, because it is difficult to do that when you have the ability.
Yeah, I really appreciate that. So awesome. I love that you're using creative. Let's partner and get this deal done. I love that. That's so cool, man.
Yeah, that's the right way to play the game, man. Like, how do we're trying to get out of the rat race here. Like, what can we do? I can't afford this property. Well, how can I afford it? Let's talk as a group. What can we do?
That's so cool. I've never heard anybody doing that. That's awesome.
Oh, yeah.
That's awesome. I'm like I said, my kids are younger. So I'm like, this is the reason why I do the podcast as a whole, because like I can't have this conversation with my 5-year-old. Like,
right.
So this is why like I record a lot of these conversations, because they're there forever. I doubt YouTube is going anywhere for a long time. So
right.
Watch YouTube.
You're not far from starting to play that game with them, man. I think they might have been 7-ish, 7, 8, something like that, and we started playing that game. So you're not far off. It's a little harder because of the math is tricky for them, but
yeah, I'll probably wait till that point, because mean, they can't even speak clearly right now.
A couple years though, yeah, they might be wanting to buy some real estate.
No, I think it's huge. And I like to get a question to heart too, because like when I grew up, we all had one car, and that's how we grew up. Like my older brother drove us all to school, and then they all worked a job till they afforded their own car, and then the car got passed down to the next driver, and that's how it was. And then my dad got me a car, but he probably paid like $1,000 for it. He's like, "Oh, here's your car," and it broke down like a week later.
Yeah, that's funny. That's how I grew up too. I paid $900 for my first car, and it broke down all the time. But I learned how to work on cars because of it, right? It was like we're talking about earlier. It forces you.
I remember after I got a really good job when I was like 18. I was making like $17 an hour. I bought a new pickup truck. It was like $400 a month, and I'm like, you know what? I just buy a new pickup truck, and that's what I did. It wasn't like the big like 2-ton 4-wheel drive, all that stuff. It was a little tiny, like, it was a Nissan Frontier. It was a tiny pickup truck, It got me to point A to point B, and I needed a reliable car. But I got that car meant a lot more to me because I bought it with my own money, you know.
That's right. That's exactly. And you took care of it, right?
And I did take care of it.
So you're not taking care of the shared car there.
I'm sure. This is your car next. You have it.
Exactly.
Here's the keys.
It's funny.
That's gotta be interesting with all the kids around that age. What's the shared car? Because you got 7 kids. Is it a minivan?
No, the shared. So we drive a Yukon Extended. So that's the one, and it fits us all comfortably.
Okay.
The shared car that they're all using is just a Pilot.
Okay.
It's got the third row, but so I'm considering switching that out for something that only has 2 seats in it though. Ooh. Because you know what happens is this turns into the community car. So now it's like all of the friends pile in, and I think I saw 8 or 9 kids crawl out of that thing one time, and I'm like, I know there's not 9 seatbelts, so that when you have the biggest car, then everyone rides with you.
That's true. I think my deterrent is making it stick shift.
If I could find one, yeah, that'll take the texting and driving. I'm gonna make it hard to text and drive, right? Yeah. I want that bad. But how do you find those? Where do you even get one of those?
I mean, you can search. I remember when I bought my new truck that I bought when I was 21, 22, that was I went to the dealer and asked for it, and they found one. And if they don't have one, they'll order it for you, and it takes a few months if you're buying it new. But if you're buying it used, you can go to some places like CarMax and search for the different types of transmissions. So you can search for a manual transmission vehicle.
Oh, that's interesting. I might do that, man.
Do they know how to drive it?
No, because we haven't. They don't even. I don't know if they've seen one.
Yeah. That's my deterrent. I want to buy a stick shift pickup truck now. That way I can give it to them, and I'll take care of it, and they can have the old pickup truck that's
there you go.
20 years old, you know, but it's a 2000, 2005. You know, it's gonna be a historic vehicle, you know.
Yeah, I might do that. So we've cruised around on 4-wheelers, so they know how to shift, but the 4-wheelers didn't have a clutch, so they don't know they don't know how that feels. But gosh, I think I could teach them pretty quickly.
Do you know how to drive stick?
Oh yeah.
Okay, yeah. As long as somebody knows how to drive, that's one thing I'm trying to do with my kids. Is they're all young, but I'm trying to instill it's already in my mind. They're getting a stick shift. I don't really care because no friend's gonna drive a stick shift because by the time my kids turn 16, 17 years old, no one's gonna know how to drive that.
No one knows how to drive that. But it's funny. You go over to Europe. So we went over to Germany. We were going to cruise down the Autobahn, and you have to you rent a car obviously, and there's like all stick shifts.
All stick shifts.
I was like, I thank God I knew how to do that. Otherwise, we wouldn't have been on our excursion that day.
I've been thinking about that too. I've been thinking about importing a car from Europe. One, because I want to drive on the opposite side of the vehicle, just mess with people. I remember the first time I saw that, it was somebody had a Jeep and they're on the right side. I'm like, I had to like double take.
There you go.
And it was a stick shift, and I'm like, oh, okay, that's pretty cool. I just want to mess with people.
So they drive on the left side in the Bahamas, and they don't have a ton of stoplights on those islands down there. So it's all like roundabouts.
Yeah.
Something to throw you off, go on a roundabout the wrong way. That takes a little bit of getting used to. Because you're on the left side, so you go into the roundabout around the left, you know. And I was on a moped, and I went the wrong way, dude. Just these cars come flying around. I'm like, oh shit! Jumped up on the sidewalk on my little moped. My first roundabout in the Bahamas. Yeah.
That'll do it.
I had no idea. Pretty funny. It's so scary.
This is such a good podcast. Where can people find you online? And what's your podcast again?
Yeah, the podcast is Real Estate Educators. It's on all the platforms. I had a great time with you, Daniel, when you came on. Learned a lot from you. Thank you for that. I am going to implement some of what I've learned. We talked a little bit about the market and the opportunities coming. So we wrote the report, comparing the 1990s crash, which none of us were really old enough to understand.
Yep.
But I definitely researched that, and I understand that it's right after the savings and loan, super high inflation, super high interest rates. right? That's what created that crash, and that's sort of the similar to what we're in right now. So I compared those two, and I wrote a report about it. I think that will shed some light on what you may expect to come. So you can get that report for free at thepinereport.com, thepinereport.com. Otherwise, reach me at pinefinancialgroup.com. I see you put it there on the screen, pinefinancialgroup.com.
Amazing, amazing. Man, I think I said this last time, but you're one of my favorite guests.
Thank you. I have a great time with you, man.
This is it's always fun. And like I hope it wasn't one of the I was trying to switch it up as far as like the topics and questions, and it's always good. It's always a good time. But I appreciate the honesty and the parenting advice, and I appreciate all that. It's good stuff.
Yeah, and you've got a ways to go here, but you're 5-year-olds, man. That's amazing time.
Yeah, it's my 3-year-old's a tyrant.
Oh yeah, I can imagine.
If you're hearing this,
have fun with that.
You are all right. All right,
that's awesome.
For everybody here, thanks for tuning in. Go like, share, subscribe. We'll see you on the next episode. Thanks for tuning in. Thanks for coming on, Kevin. Please go follow pinefinancialgroup.com. We'll see you next time. Thanks for tuning in.
Thanks, Daniel.
Hey guys, so the Hive Mind is launching a new program where we're helping you work deals that are valued at $1 million and up. If your deal is worth $980,000, we don't want to take a look at it. You can submit those deals to us at submitbigland.com, and we'll help you comp the deals. If it's good, we'll help you close it, and we'll also help you fund it and sell it. Check us out, submitbigland.com, milliondollarmastermind.com, and wholesaling $1 million land deals on Facebook. Thanks, guys.